Hello everybody, this is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool, also known by many of you as Mr. Valuation. This is going to be part 8 in a 11-part series of videos where I'm covering and looking for looking for value in the various 11 sectors under the GICS code. And today I'm going to be looking at information technology. Now this is a very interesting sector because number one is it's a very hot sector, and it's one of the hotter sectors in the market. And unfortunately, you're not going to see names like Apple or Microsoft, etc. in this video because these companies are trading at really high valuations relative to their growth, relative to their histories, relative to anything that I would consider as a value investor, anything that makes sense. But I did come up with 12 companies in this sector. And as I had been doing with all of these videos, before I get started on the video itself, I want to create a perspective. I want you to basically take a note of the S&P 500. All right, so let's go ahead and move to the FastGraph tool here, and let's look at the S&P 500 index. And as you can see, the S&P 500 has had growth since 2001 of about 6.27%. And that's pretty normal for the market over time. Now, as a result, the stock market has traded between 15 and roughly 18 and a half times earnings most of the time. There'll be times when the S&P is traded at very low multiples of earnings, 12 and 13 times earnings. And there have been times when it got up into 17 and 18, and then even times when it got up into the 20 multiples, which usually ended up being a poor time to be investing in the index. And then you can clearly see since COVID, the flash crash of COVID, we've had this just really runaway market that's gone on now for about 2 years. And that's something that I think confuses a lot of investors. You can't really time these things. The market has been running for 2 years. It is overvalued clearly by the evidence of this graph. The index is going to recover as an indice. The growth of earnings should be good for the next couple of years. But clearly they don't justify today's price. And we're starting to see a drop in rates. Now we've got things like, the Ukrainian conflict or potential conflict going on. You've got the Fed talking about raising interest rates in March. There are things that are making the stock market vulnerable relative to their high valuation. When valuations get this high, stocks become very vulnerable. So also, though, before I leave this graph, I want you to make a mental note that when you're comparing performance of these companies, which I'm going to be doing on some of them, you're going to note that you're comparing the performance of the market at an all-time high against these stocks that I'll be showing you where they're trading at lows or trading at lower ends of their valuation threshold. So keep that in mind as you're looking at these. So let's go ahead and look at the information technology sector. Again, this is going to be very high level. A lot of these companies I know very little about. I'm going to admit that to you, firsthand. So I leave it up to you to dig. If any of these companies look intriguing to you, I leave it up to you to conduct your own comprehensive research and due diligence. There's never a substitute for that, in my opinion. But you don't want to waste your time doing that either. So you want to start with companies that appear to be attractively valued. So I'm going to go ahead and start with the first company on the list here. And the symbol is AEXAY, and I think it's Atos SE. It's a French company. As you can see, it's an IT consulting services company. Very interesting graph here because if you look at it, the orange line clearly is a plotting of earnings. You can see it's really been a 15 multiple company for most of its time, especially when it had decent growth. A little bit cyclical here and there, but usually, the price, clearly tracked earnings. And then since coming into COVID, we've had this big drop in earnings and expected to drop again this year before earnings ultimately recover. Well, that, of course, has taken the stock price, which was overvalued, similar to what the S&P is today. And it really corrected and went to the mean. And then, of course, it got really cheap after that. And then it stayed weak, for all of 2019. Came into 2020, COVID hit, it really crashed, rallied pretty strongly, but earnings continued to fall away. And as a result, the stock price has fallen too. So if you're looking at a stock like this, it's trading at a blended PE of 8, offers a 2.15% dividend yield. The dividend has been cut recently and is expected to possibly be cut again going forward. So that's something you'd want to be concerned with. But what you're looking at here is an extremely low valuation. It's trading at almost half off, you could say. It's normally a 15 multiple or higher company and is trading at a low valuation, but of course that's in conjunction with very low earnings growth. Earnings yield is about 12.5%. So I would call this a speculation. If you're looking at the forecasting graphs, we are looking for a continued down year of about 12% next year before the earnings ultimately are expected to recover to 32%. It's going out to that recovery. If this went back to a more normal 15 times earnings, you would have an enormous, at least intermediate rate of return potential for this company. But I want to make it clear, I'm referring to this as a speculation. It's extremely undervalued, and it is a speculation. And those of you who are FastGraph subscribers, don't forget you can go to external links here and go into the company's website, or any of these companies' websites. And this is where you can learn about what the company does and all the different products they have. You can go into investor services and possibly find presentations, etc. So you want to do your own due diligence. A good place to start is with the company's website. So that's the first company on the list. The second company on the list is really quite a high-quality technology distributor called Aeroelectronics. Now, they're a growth stock. They don't pay a dividend. They're moderately cyclical at times. But you can see the price has really tracked earnings quite well over time. And earnings have surged in 2021, and they're expected to continue to go up 9% and possibly 3% after that. But we had this almost 89% surge. I'm guessing, and I'm only guessing here, that could have to do with the pipeline, et cetera. And they were able to basically force product out that, in this time of scarcity. So it might have really helped their operating results. Trading at less than 9 times earnings, no dividend, earnings yield of 11.9%. So again, you have another situation here where you have a company that's extremely undervalued and very speculative for the next couple of years. When I say speculative, what I'm saying is you're looking for the company to revert back to more normal valuations. Now, when you use a tool like FastGraphs, you can see that the stock has been trading below the orange and the blue 9 for quite a bit here. So it makes sense when you see that to go ahead and shorten the time frames. It should be obvious by looking at that you don't want to look at that. So you're really looking at a normal PE of about 10. So it's not quite as undervalued as the longer-term graph would make it look. So if you went to the normal multiple graph, it's undervalued. But if it just goes back to in this case, I'm using a 10.8 PE. That's the last 5 years. I could use one, a little bit more modest, like maybe we'll do a pure 10 PE. Okay, so be a little conservative. It's 10.04. That's pretty close. And you're still looking at 30% rates of return, up to 15% rates of return over the next 2 years, assuming the company, trades at moves back into a line of just a 10 PE, not the higher multiple. So this would be an interesting one. It's inexpensive. If you're looking for some growth, in the portfolio, this might be one that you might want to be interested in taking a deeper look at. Amdocs is a IT consulting services company. It's an interesting company. Growth has been about 7% a year, but one thing I like about this one, looking at this graph, it's been very, very consistent. You can see the price has tracked that. You can see when the stock got undervalued, those were really good times to buy it. I would consider the stock fully valued today. It's not cheap. It's not expensive. Offers almost a 2% dividend yield, of earnings yield about 6.5%. This could be one that you'd want to watch to see if you could get it cheaper, if you could get it like you did at COVID here. And shortly thereafter, if you could buy it 10 or 12 times earnings, it would be very interesting. Dividend record is quite good. They started out with 13 cents. Then, of course, they about tripled the dividend. And then since that time, if we go here and look at the dividend growth rates, and I shorten this time frame a little bit, you can see that, since they tripled the dividends have been growing at double-digit rates, about 13% a year. So that looks pretty attractive for this company. And again, it's fully valued, attractive in an overvalued market, perhaps, but it's certainly not cheap at this point. But yet, on the other hand, it's not real expensive. Next one I will look at is Fidelity National Information Services. This is a data processing and outsourcing company. You can see the effects of high valuation. Even during COVID, it never really got inexpensive. But again, don't be afraid to look at these stocks with these different time frames. You see about 11% growth. The company's come back into almost alignment with that growth. It's now, again, fully priced again. Looking at it, forecasting going into the future, it's expected to grow at 14 or 15% a year. So if you could buy this stock at a 14 or 15 multiple, I think it would be attractive. Right now, it might be just a little bit rich. And of course, you could see that you would have had opportunities in the past to buy it a lot cheaper. It has a good dividend record since about 2012. They've been steadily increasing their dividends. That's something else to consider if you could buy it a little cheaper. But again, relative to the S&P, it's not expensive considering technology. This is Fujitsu Limited, IT consulting and other services. Again, I like this graph because the company does have a lot of cyclicality, even times where they've lost money. And of course, that's had an impact on their stock price. But since about 2014 or so, with a lot of cyclicality, they've really grown their business pretty nicely. I can shorten the graph to show you that. It's been about 8% growth. The company was overvalued, and it's recently come back. And it looked like a big drop here just recently. That's something you'd want to possibly look into. Again, you can go into the company's website. They pay about a 1%, just under a 1% dividend yield. They have earnings yield of 7%. The PE is around 14. So this would be one that you might want to look at if you feel that a 7 or 8% grower is, worth your looking at. You might want to buy this one a little cheaper too if you got the opportunity. Just looking at it, again, from this high level, overview that I'm doing on each of these stocks. The next is Flex Limited. Flex Limited is an electronic manufacturing services company. It's, again, a non-dividend technology stock. You can really see some interesting relationships between price and earnings here when you're looking at this graph. And again, always note when you can buy these stocks cheap enough, that gives you an opportunity to make some really good, rates of return. I'll just do a quick calculation here. There's a 22% rate of return annualized over about 4 or 5 years there just by buying it when it was undervalued and then, holding it, maybe selling it when it started to get overvalued. And right now the stock is on a downturn. To be one you'd want to watch. If it gets cheaper, you might want to take a look at it. Let's just scroll for fun. Let's see what it's doing today. It's actually up a little bit today, but it's still very inexpensive. PE is under 10. It's 9.2. Earnings yield is 10.87. Once again, this would be more of a short to intermediate term holding, in my opinion, but it could turn into a long-term holding if they were able to keep growing. So that's something. What I want investors to do is invest with open eyes so that you know what's going on. HP Inc., one of the Hewlett-Packard companies, you can see it's trading at very inexpensive. Again, if I change these time frames, you see over the last, since 2010 or 11, it's been trading around 8 times earnings. It's trading at 9.35 times earnings, but earnings are beginning to accelerate. So that, there is a very strong possibility that we could see a reversion back to a 15 multiple, which typically an 8% grower would deserve. But even if you look at it from the normal multiple, the company does have, just right at 9 to 10% rates of return. It does have a dividend yield of 2 3/4, so that gives you a little more income than a lot of them. A 9.35% blended PE, earnings yield of almost 11%. So HP Inc. looks attractive here from a valuation perspective, depending on what your horizons are and what your goal is. It's one that I think is certainly worth investigating. Intel, a lot of people have asked me to cover Intel. Intel is very interesting. You can see in the long run that Intel is obviously the largest semiconductor manufacturer. They've had some cyclicality in their earnings. Right now we're seeing earnings drop, and we're also seeing operating cash flow hold up pretty well during this time, but free cash flow is expected to really drop significantly. But the reason for those drops are important. The company has announced a $20 billion manufacturing facility in Ohio, being one of the largest in the world, and they plan to make their high-end chips there. So, this is where you're looking for the turnaround. The stock is certainly inexpensive enough that you could speculate in that turnaround, but I don't expect that turnaround to happen very quickly. So this year could still be problematic for Intel if, depending on earnings announcements. They just recently announced earnings, and, earnings were down a little bit. Their stock has been performing kind of in line. They're off just a little bit today. That's something to consider. So you might want to watch Intel. It's certainly cheap enough that you could start nibbling on it. And again, but you got to expect this to be the turnaround. The $20 billion, investment is a big investment for them. But if you look at it with things like EBITDA and so on, it looks a little bit better. It's earnings before interest, taxes, depreciation, and amortization. And similarly, it makes sense to look at operating margin and look at EBIT here. And it looks very inexpensive relative to EBIT. So, Intel's one that you might want to take a closer look at and at least put on your radar for investing in the future. Jabil is a really interesting growth stock. I'm looking at it here from a standpoint of EBIT. You can see that the stock is, very undervalued. I'm going to go ahead and switch it to adjusted operating earnings. Earnings have been accelerating dramatically, and the stock price has reacted to that. It's still forecast to continue growing at about 11% a year going forward. So I would say the stock is very, very inexpensive. On a normal multiple of about 11 or 12, it's also undervalued and inexpensive, offering you the potential to make double-digit to mid-teen annualized rates of return over the next several years. The next stock we're going to look at is Micron Technology. This is a very interesting company here because the cyclicality here is enormous. I want you to notice that. But the company does grow. If you shorten these time frames, you get to see that the company does, end up with incredible growth rates. But the problem is that it's not repeatable. It's not very reliable. So you get these nice growth rates, but they're really a function of all this cyclicality you see going on. This is the kind of company that often makes more sense to look at them from a standpoint of EBITDA. Long term, it looks like it's reasonably valued in EBITDA. But notice when I draw it shorter term that it's trading at a relatively high multiple. EBITDA has been averaging about 16.5% growth since 2014, last quarter 2014 into 2015. This does have a August fiscal year. That's something to take note when you're looking at this. But again, it's not dramatically expensive compared to its growth potential. It's expected to grow at about 20% a year going forward. And keep in mind the cyclicality that you see with this stock is that's not an unrealistic, or perhaps not an unrealistic expectation. That would lead us to want to look at the earnings scorecard, and you can see that the earnings scorecard is rather spotty. The analysts miss earnings quite a bit, and it should become pretty clear to you that when you're looking at this kind of cyclicality in the stock, that it becomes one that's very difficult to analyze. But anyway, there's Micron Technology for you. Qorvo, which is a semiconductor manufacturer, is more of a growth stock. You can see if I run this for like the last decade, you can see that they've grown EBITDA by about 26% a year. The stock, normally trades pretty close to that. It's obviously at a good buy point right now based on that metric. If we look at it from a standpoint of operating earnings, which I like to look at, it looks very, very inexpensive relative to the growth. Forecast growth is expected to be over 16%. So this is a growth stock that I think has become very inexpensive here, and it's one that you might want to take a close look at if growth is your objective. Samsung, we all know, one of the big technology, hardware, storage, and peripherals company. Very, very cyclical, normally trades at a very discounted valuation. I think I want to point that out. So even though the company looks inexpensive based on the earnings line, if you look at it from a normal multiple, about 9 or 10 times earnings, it's probably a little bit rich. But this is one that's at least reasonable compared to some of these other tech stocks, I mentioned earlier that are extremely expensive today. Well, there you have it. That's 12 stocks that I've screened for in the information and technology sector. You've got, some very interesting companies here. The valuations are interesting on some of them. Some of them are speculation. Some of them are good, solid investments. But all of them are inexpensive relative to what you see in the S&P. And keep in mind, technology is what dominates the S&P right now, with big names like Microsoft and Apple being such a large portion of the index. So anyway, this has been Chuck Carnevale saying thanks for watching. This will be part 8 of my series on, my screens for information for going through all the various sectors. I'm still going to be looking at real estate, utilities, and there's one more. Let me see if I can real quickly bring up to you. I've got utilities, real estate, and materials will be the next one I do. So tune into those, if you will, and that'll complete. The next 3 will complete my series here on the 11 sectors and, looking for valuation in there at a high level, looking for companies that you can research and begin analyzing maybe that might fit into your portfolio. Give me a like if you enjoyed this video. Follow the channel if you don't already. And don't forget to take a look at the Fast Graph Value Academy. It's a free academy where, finance is being taught at a pretty high level, I think you'll find. And we've got several videos posted now. We'll be posting several more in the future. Anyway, thanks for watching.